This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to Chapter 2 of our series, Cryptocurrency Mastery, The Path to New Age Wealth. In this episode, titled Cryptocurrency Investment Strategies, we're diving into the various approaches you can take to navigate the exciting world of crypto investing. Whether you're a seasoned pro or just starting out, you'll discover valuable strategies to help you make informed decisions. Let's get started. Last year, one coin quietly turned a few $100s into a down payment on a house, while most others crashed. In this episode, we dive into that paradox, how the same crypto market can make and destroy wealth with the exact same price chart. That split outcome wasn't random luck, it was strategy. The same market, the same wild swings, two very different playbooks. One person chased every spike, went all in on hype, and panicked on the first red candle. The other treated crypto like a long campaign instead of a single battle, sizing positions, adding on a schedule, and refusing to let one trade decide their future. In this series, we're shifting from which coin should I buy to how do I build a system that works even when I'm wrong a lot of the time. We'll explore how long-term holding, dollar-cost averaging, and thoughtful diversification can quietly beat most attempts at perfect timing. Think of it less as hunting a jackpot and more as curating a small gallery of pieces you understand, review regularly, and only replace with something better, not just louder. Now we zoom out one more layer. Before picking coins or timing entries, you need a personal mission brief. Why are you in crypto at all? Aggressive growth? Inflation hedge? Tech conviction? Or just curiosity? Your answer quietly dictates everything. Which assets belong on your radar, how much volatility you can stomach, and how often you should even open a price app. Just as a traveler chooses routes based on time, budget, and risk tolerance, your roadmap should match your real life. Income stability, savings cushion, debt, and time horizon, not someone else's screenshots. Here's where your mission brief becomes real. Numbers, not vibes. Before picking any coin, you need 3 guardrails: risk budget, volatility tolerance, and time commitment. Skip these, and the strategy you think you have will quietly dissolve the first time the market drops 40% in a week. Start with a simple risk budget. Decide what percentage of your total net worth is allowed to live in crypto. For many non-professionals, that ends up somewhere between 1 to 10%, depending on income stability, emergency savings, and how exposed you already are to risky assets like startups or stock options. This is money you can afford to see cut in half without missing rent, loan payments, or sleep. Next, translate that high-level number into per-position limits. If your max crypto allocation is 5% of net worth, you might cap any single asset at 1 to 2%. That way, even if one coin goes to zero, a real possibility in a universe where thousands of tokens never recover, it stings, but it doesn't rewrite your life plan. This is where the raw stats matter. When an asset class can swing 10 to 20% in a day, small initial sizing isn't cowardice, it's respect for the math. Then, match your volatility tolerance to how you participate. If you can't check markets often, and price swings make you compulsively refresh apps, high leverage trading or obscure microcaps are structurally misaligned with you. A calmer mix, major coins, some staking, maybe a small experiment bucket, will actually let you stick to your rules when things get loud. Finally, decide on your time commitment in hours per week. Treat this like choosing a side project, not free money. A passive approach might demand 1 to 2 hours for rebalancing and tax notes. Active trading or DeFi strategies can easily eat 10 to 15 hours and still leave you behind a simple plan. The paradox: the more frictionless the apps feel, the more you must deliberately slow your decisions with predefined limits and checklists. Your mission brief isn't a manifesto. It's a set of constraints that keep you from negotiating with yourself in the middle of a crash. Think of your risk budget like planning a trek through unfamiliar mountains. You don't just say, "I'll walk until I'm tired." You map fuel, weather windows, and bailout points before you start climbing. In practice, that might mean splitting your crypto slice into 3 labeled routes: a core base layer, assets you'd be okay holding for years; a tactical layer, shorter-term bets you actively monitor; and a tiny lab for experiments. Each route gets its own rules: maximum loss you'll tolerate, conditions that trigger trimming, and how often you're allowed to touch it. Concrete example. Someone with a 4% total crypto allocation might reserve 2.5% for established networks they've researched deeply, 1% for mid-caps tied to themes they understand, like infrastructure or gaming, and 0.5% strictly for learning, new protocols, DEX pools, or staking setups. That structure turns vague intentions into visible containers, so when a friend shills the next big thing, it must fit inside that small lab box instead of quietly invading your whole plan. Volatility isn't just noise, it's the tuition you pay to access future opportunities. The more precisely you define your risk and time inputs today, the more optionality you preserve when the landscape shifts. As tokenized assets, AI-driven tools, and new regulations arrive, a clear brief lets you adapt instead of react. Like a traveler with a well-packed bag, you can change routes on short notice, adding, rotating, or exiting positions without scrambling to rebuild your entire plan from scratch. Strong plans stay flexible. As your income, goals, and tax rules evolve, your brief should too, like tuning an instrument before each gig, not just once. Stress test it. Assume a 60% drawdown, a sudden windfall, or needing cash fast. If your rules still guide you calmly through those forks, you're not just investing in crypto, you're designing how you'll respond to uncertainty. Before next week, ask yourself, 1. If I limited myself to just 3 crypto assets, which ones would I actually hold based on their use case, on-chain activity, and the teams building them? And what specific data, for example white paper, GitHub commits, active addresses, will I review tonight to justify each choice? 2. Looking at my current portfolio, how much could I realistically afford to lose without derailing my other goals? And what concrete position size limits, in dollars or percent of my net worth, should I set for each coin starting today? 3. Given the volatility we discussed in the episode, what exact rules will I use for entries, profit-taking, and stop losses? For example, DCA schedule, percent pullback to buy, percent gain to skim profits. And how would today's prices change my next move under those rules? This was OwlUp, your daily step forward. This series continues with more chapters on OwlUp.co. Visit OwlUp.co to access the complete course and continue your learning journey. See you there!